Hi everyone, I'm Jeff Sarti, CEO of Morton Wealth, and I'm joined by Meghan Pinchuk, our Chief Investment Officer. Excited to have our quarterly market review update. But before we do that, I wanted to quickly mention, you might have seen an invite or a save the date. We have our upcoming, it's our third annual investor symposium.
It's crazy, it's the third.
I know, right? Yeah. So in October 17th at the Westlake Village Inn. Super excited for this event. While the last 2 years have been great, I think we've even, in many ways, upped our game in terms of the agenda, the content. We're gonna have a lot of investment-related content, some good financial planning topics, some great speakers, so hopefully you can join us there. All right, with that said, we're gonna dive into the market review. A lot to talk about. We're gonna talk about the economy, various outlook for different asset classes. We're even gonna talk a little bit about the political environment. But the main theme we're gonna talk about today is the stock market. Stocks have been really on a tremendous run, really for the last year and a half, since 2022, and year to date up about 15 or 16%. And it's somewhat puzzling to most observers of why stocks have done so well. Because if you think about the backdrop, growth has been relatively slow. We're not in a recession, but it's not like economic growth has been robust. Inflation is still somewhat elevated. It has come down, but it hasn't reached, call it the 2% target that the Fed is going for. Interest rates still remain elevated. We have geopolitical risks that are still prevalent. And now, as I quickly mentioned before, the political environment. So with all that being said, stocks have still continued their run. Can you talk a little bit more about that?
Yeah, and it's a big run, at least for the headlines are big. So you have the S&P 500 up 15% just for the 6 months of the year. That is not an annualized number. That's just for 6 months. But that really doesn't tell the whole story. So you look a little bit under, and it hasn't really been as broad of a rally as that would say. You think, oh, 500 stocks, like that's pretty good. But you look at a couple other things. One is small companies. So instead of the S&P 500, being just the large companies, let's look at the Russell 2000. That's 2,000 smaller U.S. companies. Mm-hmm. And so those are only up about 1% for the first 6 months. And that is a big gap. Usually, sometimes you see discrepancies in those two.
Maybe just by a few percent.
Yeah, nothing like that. Like historically, this is a big gap.
Yeah.
The other one that tells the story, I think, a little more even articulately, is the S&P 500 equal weight. So as a reminder, the S&P 500 is actually not just a good broad index, it's actually a strategy. So it is a growth strategy momentum. The biggest companies have bigger weights in that index.
So it's a market cap weighted index. It's not equally weighted across the 500
Correct.
companies.
So that's one way, and that's the number that you see in the news. And then the S&P 500 equal weight is exactly as it sounds. Just take the 500 stocks, everyone gets an equal share. It doesn't matter how big the company is. Mm-hmm. So that equal weighted index is only up 5%. So again, a big gap between that and the headline numbers people are seeing, which is really indicative that the broad market has not done as well, and that there's just a lot of concentration in terms of the top performers so far. Mm-hmm. And that concentration has also continued to widen in terms of how big the gap is. So right now we've seen that about the top 10 stocks
in the S&P 500?
In the S&P 500 are about a third of the index. Mm-hmm. So that's a big weighting. And so they represent, as a result, about 70% of that 15% return for the first 6 months.
So just to clarify, so of the 15% return, call it 10 or 11% of that 15 was just generated by those 10 stocks.
Just 10 stocks, right? So it's really very narrow in terms of what's driving performance. And even a little crazier than that is actually the top 3 stocks, which are Microsoft, Apple, NVIDIA. So names everybody knows. But those are at the point where they're over 20% of the makeup of the index. So it's really pretty extreme.
So these extreme levels of concentration, again, somewhat unprecedented. Only 2 other times in history where the market has been so concentrated in just a handful of stocks. The other 2 times, one of them was the late 90s dot-com period, where the mega technology stocks really ruled the index. And then the other time frame was a few decades back. Some might remember the Nifty 50 time of the early 1970s. The Nifty 50 stocks, it was a term for blue chip bellwether stocks that were theoretically at the time deemed to be recession resistant. It was companies like IBM and Xerox, Polaroid, which no longer exists. But a consistent theme with those 2 time frames were people were chasing the high performers. And it's not a coincidence that those time frames represented also peaks in the stock market. Shortly thereafter, we did hit some rough patches in the 1970s and then after the 1999 dot-com bubble. And it makes sense because When you think about concentrated stock markets like we have now, when speculative fervor enters into the stock market, what happens is people start to chase the stocks that do well. Right. So in the current environment, people are chasing Apple and Microsoft and NVIDIA, and what are they doing? They're selling their other stocks. So it's sort of a story of the haves versus have-nots in the current market environment.
The consequences, too, of some of these bigger companies doing so well and becoming bigger and bigger pieces is that their valuations are getting very extended. So in particular, we'll talk about the broad market in a second, but in particular, some of these bigger stocks, they are at very high valuations. Some of it is starting to echo a little bit, even some of the crazy valuations of the late 90s. NVIDIA being, I think, the best example. If anyone remembers Cisco, that was the darling of the 90s and its rise and fall. It was trading at a similar valuation metric, price to earnings ratio, we'll talk about it a little later, but basically a similar valuation metric as NVIDIA is today. So kind of insane numbers. The flip side is, though, NVIDIA's had pretty insane growth.
It's growing tremendously well from an earnings point of view.
Exactly. The earnings have been great. And so now the question is going to be, though, going forward, it's pricing in that crazy growth is going to continue. So at this point, that's a little speculative of will that run continue to justify the current very high valuations?
So yeah, NVIDIA is an interesting story because it is growing so much, but there's some other stories where the earnings or revenue growth are not as robust, yet valuations have really risen. I'll talk about Apple as an example. Apple is now a $3 trillion market cap company. In 2018, just 6 years ago, it was the first company to cross the $1 trillion mark. Then in 2 short years after that, in 2020, it crossed the $2 trillion mark, and now just a few years later, it's $3 trillion in terms of its market cap or total market value. So you would think that Apple's done incredibly well from an earnings growth or revenue growth point of view. That's actually not the case. It's been more of a story of valuation expansion, meaning its PE ratio, as you alluded to. It's trading now at a 35 price to earnings ratio. By way of reminder, what is a PE ratio? If you take the earnings, let's say a company has $1 per share of earnings, a 35 PE ratio would imply that stock price would trade at 35. Apple, throughout its history, in previous decades, even when it was growing faster, typically traded in the mid-teens in terms of a price to earnings ratio. I mean, now it's trading at a 35 PE ratio. So the thought again would be, oh, Apple must be growing at a very high clip. It's not the case. If you look at its earnings over the last few years, growing modestly, in 2022, it earned about $6 a share. Now, 2 years later, it's about $6.50. So growing, but at a modest pace. Its revenue or sales have actually been flat over the last 2 years. So this is not a growth story. Again, Apple's a wonderful company, but when you think about a 30 plus PE ratio, that would be justified by a company that's growing at a very fast clip, and that's not the case with a company like Apple.
Yeah. And so when you think now about, obviously we talked about these couple large companies being big drivers of the market. The broader market, though, including those companies, is also overvalued. So not quite to those extremes as these handful, but the S&P 500 is trading at a price to earnings ratio of about 23. And it's typically that one's more in the mid-teens in terms of historic levels. So call it about 30-ish% overvalued. And so, look, there are periods of time actually that are justified, that high valuations are justified. Like if you had really robust economic growth, if you had low interest rates, low inflation, good geopolitical stability, all the things that we do not have today.
Sure.
And so that is where I think that it's challenging to sort of wrap your head around, like, we're trading at very expensive valuations, but things are really more uncertain and potentially challenging. So, it feels uncomfortable. I think the other side of that, though, is that we're looking at this saying, like, okay, stocks, and we're talking about, again, stocks overvalued. Do you just kind of, are we calling for a crash or a big correction? And that's not the case. And the primary reason for that is that valuations, while they're actually a very strong indicator of future returns on a long-term basis, which we're going to talk more about, short-term, it doesn't mean much.
Right.
So if it's overvalued, it can continue to be more overvalued and kind of keep running. And so I think it's more about looking now at the long-term perspective and kind of where things are.
So along those lines, can you just talk about, we're concerned about stocks and valuations. Why invest in stocks at all then?
Yeah, I think that you need stocks as access to global growth. It's a cheap, efficient way to get access to the global growth of the economy and to participate that way. And as part of, we talk a lot about true diversification. And so usually we're talking about that in the context of alternatives. But stocks are a piece of that, and I think an important piece for most investors.
So you hit on a key component of why we own stocks in client portfolios. They're a core component of the long-term growth element of your portfolio. And it makes sense, right? Stocks grow fairly, there's volatility intra-year, but over the very long term, stocks have shown robust growth. And the data shows that. If you go back literally 100 years, stocks have averaged roughly 9 or 10% per year. But if you ask most investors what does long-term mean for them, they would say the most typical answer is we get 10 years. And the expectation is that stocks should do well over most any 10-year period. But that's actually not the case. What history shows is you can have plenty of 10-year periods where stocks are actually relatively flat in terms of performance. If you look at the last 100 years and bucket into 3 30-year buckets, what you see is an interesting pattern of typically 15 to 20 years of very robust growth, actually well above that 10% annualized growth, but then 10-year long periods of relatively flat growth where your stocks go sideways and actually lose out to inflation. So the point being that actually we believe when you own stocks, you should have longer than a 10-year mindset, but even a 15 or 20-year mindset when you own stocks.
All of those weak periods that you referenced, they had one thing in common, which was they started from very high valuation points. So even as I was explaining how short-term valuations may not drive things, actually longer term, that 10 plus years, like beyond that even, valuations are the main driver of it. It's not the economy, it's not interest rates, it's not even geopolitical issues. It is really where valuations are.
To your point, starting valuations are the most important driver of future long-term returns. So going back to the last 100 years, a couple of examples. We all know 1929, right? The famous stock market boom and bust.
Glad I wasn't alive for that one.
Right? PE ratios hit all-time highs at that time. PE ratio of 20, and then the stock market collapsed. It took until 1943, 14 years for stocks to break even. So literally if you bought the stock market in 1929 at its peak, you had to wait 14 years for your dollar to come back to $1 14 years later. Then for 20 years until the mid-1960s, stocks did very well. Again, hit a PE high of 18 in 1966, so stocks became expensive again. Took until 1974 for stocks to break even. So that was roughly an 8-year time frame. But that doesn't tell the whole story because there was high inflation in those years. So you actually lost out to inflation. Stocks did not break even with inflation until 1982. So it took 16 years for stocks to actually break even with inflation. Then again, a bull market in the 1980s and 1990s. We all know what happened in 1999. Stocks got very expensive, traded at a 33 PE ratio. But then what happened after the stock market crash took roughly 10 years until 2010 for stocks to break even, bottoming at a 13 PE. So I think it's just important to understand the prevalence and to some degree predictability over the last 30 years of these 30-year cycles.
And stocks have been a great place to be for a long time now, to the point we've been in a good part of the cycle for quite a while. Mm-hmm. And so now, though, if you had challenges too, not only are you dealing with an asset class that might not give you the 9 or 10% a year, but also with a lot of volatility, so not that fun of a ride. I think there's the potential for major volatility, whether it's up or down, is something that investors have to look at really closely in the current environment. There are a lot of vulnerabilities out there. There's a lot of uncertainty. And so there's the potential, as you said, for this more expensive PE ratio, the valuations, to get cut, and that you could have a nasty downturn. And so when you're looking at your financial plan, you have to look at that and say, okay, how much can I have in this bucket of stocks where I can live on or spend the rest and I can truly leave this long term, not just 5, 6 years, like I can leave this 10, 15, 20 years and wait for it to come back if that happens. I actually think the other side of the coin, though, is just as important. So investors have to also think about what is the upside from here, and if stocks continue to really run, what does that look like, and are they going to have serious FOMO or fear of missing out? Because what you've got is we have had some euphoria in terms of NVIDIA, certain names, but it's not quite as broad as it was.
Yeah, like it hasn't been extreme. Yeah.
So you could see major blow off from here, essentially, where stocks really continue to run for some period of time before there's some type of correction. So investors have to be prepared. Do they have enough stocks also in their portfolio where if that happens, they feel like they're participating enough? So with all this uncertainty, I think it's a challenging environment, and coming back to your financial plan and working with your advisor to make sure it is the right mix is really key.
All right, so that was a really good discussion around stocks and where valuations currently are. Let's shift gears. Let's talk about bonds as an asset class. Bonds, which used to be very boring in a zero interest rate environment, there's a lot of excitement around bonds. So can you talk a little bit about bonds as an asset class?
And just to recap the last couple of years, I think that 2022 started a really challenging period for bonds. So that was the broad index, which it's called the Barclays Aggregate. It's made up of more government bonds and corporate bonds. And it had its worst year ever in 2022. So that was very tough. And then in our bonds, just to be clear, so we've had for a while very limited exposure to more traditional bond risk. So interest rates, being farther out, basically that exposure that if interest rates, came up, we would lose. And so we really avoided a lot of those pitfalls. Going into 2023, what you saw was it was another volatile year for bonds. They got bailed out a little bit, so interest rates came down a little in the fourth quarter.
Of the year.
Right at the end. And so then that index was okay. It was up about 5, so nothing amazing, but nothing terrible. So now this year, through the first 6 months of the year, the index is basically flat. Mm-hmm. And so it's been another challenging period where investors are sitting there sort of not getting paid and with reasonable volatility too for what's normally a ballast in the portfolio. And so we've been really happy. Our exposure, again, is just very different than these traditional indices. We're not looking to bet on interest rates up or down. We're not looking to, sort of have more of that traditional exposure. And because of that, a lot of our strategies, again, we've been really pleased with how they've held up and done well in the portfolio. So that brings us a little bit to private lending. That's been a consistent thing we've hit on the last several, I think, quarters. And so I'm not going to go too much into it, but I will say that the story, I think, holds in terms of this continuing to be a really attractive asset class. So we do private lending actually even a little different than you hear in the headlines. We focus very much on, again, not taking interest rate risk, on having assets that are backing the strategies. And as banks have continued to shy away from lending, the opportunities we've seen have really persisted. Where again, you're getting pretty strong target returns at what we think is very reasonable risk.
In many ways, with banks continuing to retrench and not avoiding a lot of these lending practices that they were lending aggressively on just a few years ago, we're able to target, in many ways, lower risk loans at still high yields. So we're still generating high yields, but at a more conservative profile than before.
Yeah, a lot of our managers who are making these loans are saying that the quality of the borrowers that are coming to them is much higher than previous, because those borrowers previously would have just gone to a bank, and now they can't, and so they're coming to them. And so it's a higher quality, a safer loan, to your point, but they're still getting paid these very high rates just because of what's happening with interest rates in the market.
Can you talk a little bit about real estate lending? Most people are aware of real estate because, at least locally, home prices continue to stay elevated, but that doesn't tell the whole story, obviously. Real estate across the board, across the country, whether it's multifamily, industrial, storage, et cetera, has been challenged, and prices have come down a little bit. So how has that affected our real estate lending strategies?
Real estate is very interest rate sensitive. So with higher interest rates, you would expect to see cracks in the real estate market. And we are starting to see it to some degree. It is very local, to your point. So the specific market and property type in particular that you're in are very much drivers right now of whether there's any kind of challenges that are being faced versus in some markets, to your point, things are fine, right? Single family homes, in Southern California being a great example of that. So we've been with this strategy, and it's been a core component. It's basically bond substitute for us since 2010, and we've been very happy with it over time. I think there are starting to be challenges. It's very dependent. Some managers are kind of not seeing that because they have a certain type of property. Others are starting to see, potential issues tick up. If the manager's making a loan and they have enough of a cushion built in, right? So they're not lending 100% of that property value. They were lending 60 or 65%. If there's enough of that cushion, even with prices coming down, they should still be okay from a principal protection standpoint. That is different though than liquidity, right? And so if that borrower can't pay them anymore, do people have to start increasing foreclosures and things like that, taking back properties? It hasn't gotten to that point yet. It's just we are watching it closely, and there's starting to be some cracks. And so and our managers are watching it very closely. So again, I think you're in a good position right now, and you're getting paid a little bit more for it too. Yields have come up somewhat. But it's definitely something to watch going forward.
Yeah, no, it's something we're definitely laser focused on. But from a big picture point of view, private lending in general, whether in real estate or outside of real estate, has been a very robust asset class for us, where we can generate what we believe equity-like returns at much reduced risk.
And again, the key being that to us, there's a backup plan to it. So when you lend, there's a bond out there, right? And you've basically lent money to a company. If the company goes out of business, there's really not much recourse for you. Like, what are you going to do to get any money paid back? In this case, again, if you've got assets backing it, whether it's more on the corporate side or on the real estate side, again, there's a backup plan. It might not be fun. You might have to go through a process, again, getting a property back and deal with the illiquidity that comes with that. But it's not just like, oops, I lost money. So that gives us a lot of comfort.
All right, let's shift gears a little bit. Again, let's talk about gold. Gold has been a core part of our portfolios going back really even upwards of a decade. Gold has done well, especially of late. I believe year to date, it's up in the mid to high teens range. And even going back in the last decade, of course, from year to year, there's a lot of volatility around gold. But over the last over the last decade or so, has done very well. And the rationale, by way of reminder of why we really entered into gold upwards of a decade ago, it was a large result of the 0% interest rate environment, money printing embracement that our government had around debt. All of those things gave us a lot of concern, and we felt the ultimate result would be a debasement of the dollar, and it would show itself in the way of inflation. And so that was one of the main reasons why we felt that at least a modest position in gold as an insurance policy, an alternate currency that cannot be printed, was a prudent position to have in the portfolio. Now, fast forward to the last couple of years, what's been interesting is as interest rates have risen, so they rose from 0% to now 5%, and they've been stuck around 5% for the last year and a half or so, gold has still done very well. And that's caught a lot of people by surprise.
It's a little surprising.
It is surprising because most believe that higher interest rates are bad for gold. And that makes sense because there's an opportunity cost when you own gold, right? As an alternative, you could just buy a treasury and make 5% versus owning gold, which spills off no yield whatsoever. So why would you own gold in that environment? And I think in essence, what the gold market is telling you is that, at least per the gold investors, that 5% interest rate is not enough compensation to compensate you for those inflationary or debasement risks that we're concerned about.
It's worth it for people to give up the 5% for some amount to have that alternate currency and feel like they've got some protection there.
Exactly. And so I'd like to just challenge even the general concept and belief that high interest rates are always bad for gold. It really depends why interest rates are high. If interest rates are high for more traditional and classic reasons, that an economy is growing and robust and therefore it warrants a modest to higher interest rate environment, the 1980s and 1990s would even be examples of that. Gold should not do well. There's no real need for that type of protection in your portfolio, and gold did not do well during those decades. We're in a different environment. Currently, the reason interest rates are higher is not because of robust growth, but it's because of inflationary concerns. The 1970s, another similar example of that, where gold also did well. So again, as long as these concerns persist around inflationary concerns, potential federal and monetary policies around debt, money printing, et cetera, we still believe it makes a lot of sense to at least have a modest position of gold in your portfolio.
Definitely. Shifting gears a little bit, I think it's not quite November, but it feels like it. And so I think we have to hit on a little bit in terms of politics here and just some of the upheaval that's happened, especially in recent weeks. It's been wild. And so when we look at this, I think there's a lot going on for investors and from a financial standpoint to be aware of beyond just the headline race of who wins the presidential election or who takes what house. Mm-hmm. I think that when we look at it, we're thinking about a couple things. We're thinking about a number of the different bills that are coming up that would potentially expire in the coming years if the right political party and mix doesn't happen. And specifically, there was the jobs, the tax.
The 2017 Tax and Jobs Act.
That one. So specifically, that one is coming where if that expires, that will really affect a lot of things. It'll affect personal taxes, business taxes, and estate taxes. Yeah. So there's potentially some large changes coming that will need to be addressed from a financial planning standpoint. I guess the good news is we have a little time. That's not sort of a November thing. It's more something that we're going to see transpire afterwards. So potentially a big impact from this election, but it's something that we'll have time to plan for. Mm-hmm. We are having a lot of clients come to us and ask, given the uncertainty and the potential for even unrest and volatility, So is my portfolio positioned well, and come back to that. And I think that there's a lot of uncertainty out there, and that is generating a lot of angst.
So to your point, it's really understandable that uncertainty often leads to anxiety on the part of investors. And what investors typically then want to do to exert control around that uncertainty is to predict the future and predict an unknowable outcome. But we've talked a lot about in the past. We believe that's a lot of wasted energy. History is just littered with examples of that. The most glaring one in recent history is the 2016 election. We all know Hillary Clinton versus Donald Trump. Hillary was the betting favorite by a large degree, and then Donald Trump won on election day. Surprised most everyone, right? But even more importantly, for those few economists that predicted Donald Trump would win, the general consensus was if he did win, the stock market would hit some economic turbulence and volatility along the way. And that did not happen. So it just shows you have to get it right both ways.
There's a lot of stuff to get right, yeah.
Not only do you have to predict correctly, but then you have to know which way the market will react as a result of that prediction. Easier said than done. So how do we approach a world of heightened uncertainty, which we currently are facing? It's building a more resilient, robust portfolio. We use the analogy in the recent past of riding waves. You don't know what shape or size or speed that wave is ultimately going to hit you. But instead of trying to perfectly time the market and surf that wave, we get off the surfboard, we ditch it, and we build a more resilient boat to ride and withstand waves of all shapes and sizes. And we do that by building a more, again, resilient, diversified portfolio.
The neat thing about this environment too is that you can actually build in some of those more resilient components, right? Protect against some of that uncertainty, but it's not like you're on the sidelines just waiting. There are some really attractive things right now where I think you're getting paid really well to take on a lower level of risk. And so it's sort of a neat time in history when you can have your cake and eat it too a little bit.
Yeah. So Megan, this was great. Really enjoyed it. And thanks everyone for watching.
Thanks so much.